Well, good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. So, David Weild is an interesting gentleman. He owns a company, runs a company, chairman and CEO of Weild and Company Inc. He's got an incredibly impressive background in banking with Prudential Financial, New York University School of Business, the Leonard and Stern School of Business. But he was also vice chairman and executive vice president of the NASDAQ stock market. So he's been close to raising money and stock market for a long period of time. And he's now arguing that there's something wrong with the stock market and has published a paper that talks about how we can improve the way we finance small companies. David, how are you? Welcome to my show.
Terrific. Nice to see you, Brian.
So tell me what it is that's wrong with our current stock market and our regulatory system and raising money for startup or smaller companies.
Well, you have to go back through the history, and I would say that maybe so far our crowning achievement, and hopefully it's the first of many to come, was getting the Jobs Act passed in the United States, which creates different mechanisms for small companies to raise capital in the U.S. It's also important because one of them, Regulation A+, is actually available to Canadian issuers as well. I think they're the only non-U.S. issuers that this encapsulates, but it sort of was an idea of IPO light. But what happened, we found out back in the 1990s, we were looking at data, that the small IPO had sort of gone the way of the dodo bird. We used to be 80% of all initial public offerings. These were sub $50 million IPOs. And then it basically, over a very short period of time, in the height of the dot-com bubble, 97 to 98, it dropped to 20% and never recovered. And so, when we started to peel the onion, so to speak, we discovered that 97, 98 is when we shifted to electronic markets and we cut trading spreads and commissions, which was the incentive for brokers to remarket stocks in the aftermarket. So brokers were getting, pushed out of the market. They could no longer get out there and earn a living telling stories. And you keep going forward, and this sort of mad crush to automate trading and cut commissions essentially made it non-viable for brokers to act as stockbrokers any longer. And so they were the ones that provided the remarketing of securities to support these prices and the distribution, if you will, to raise capital for corporate issuers. And so we went, I kind of argue, we went from hundreds of thousands of brokers that really talked stocks and bonds all day long in the United States to hundreds of thousands of people that suddenly had to re-engineer their business model, and they started earning money as a percentage of assets under management, more like portfolio managers, if you will. But in this case, they were allocating those assets to exchange-traded funds and closed-end funds and mutual funds and private equity funds and funds. So it went from culture a bit of and stocks for all day long to an advisory fee, so to speak, and that had really horrible consequences. If you went back in time, you would discover that we were probably overcharging people on large capitalization, innately liquid stocks with the old quarter point trading spreads of the old NASDAQ markets. Canada did this as well. Obviously had fewer large capitalization companies given the size of their economy, but they started and the Toronto Exchange acquired exchanges and tried to rationalize their business by moving them onto their platform, which actually took out economic support from micro stock, cap stocks in Canada as well. I know that market a little bit less well, but structurally, I think they did some similar things. The United States had a one-size-fits-all stock market that really advantaged market makers making markets and supporting stocks and brokers supporting stocks. And it really probably overcharged people for innately liquid, large capitalization, network effect securities. And then they flipped the whole thing on its head and created a market which which was intended to get the intermediaries out of the middle with these electronic hyper-efficient stock markets with no commissions and no trade and no trading spread. But the problem is that it was that market, which was now optimized to drive liquidity for large capitalization stocks, was an unmitigated disaster for small cap stocks. And the significance of that is that it raised the bar on getting companies public in general. So one of the pathologies that you see in the market today is this proliferation of SPACs, special purpose acquisition companies, right? And they're sold to volatility buyers, not sold on fundamentals. And the reason why they exist is because the probability of getting a company done because of the loss of fundamental distribution, remember these brokers are now asset managers, they're not stockbrokers, that you don't have the distribution to get IPOs done and supported at earlier stages. And so consequently, the incubation period has gone up. And if you look at Silicon Valley, you'll find that, you know, we're only taking unicorns public, if that, and even the unicorns now want to do self-direct, they want to do direct listings and avoid Wall Street, because Wall Street's institutional distribution has so shrunk that, you know, that they're now catering to the large commission buyers, and the fundamental long-term holders are just not, they don't generate enough in the way of commissions anymore at penny increments in trading to justify being actively covered by Morgan Stanley, Goldman Sachs, you know, Bank of America, Merrill Lynch, Credit Suisse, you name it. Right. And so we've got ourselves in an unhappy sort of market structure setup, which undermines our growth potential, our innovation potential, our job creation potential. And it really needs a wholesale rewrite so that, and I'm not saying abandon large cap markets, but what I am saying is that we need a different market structure to do that is optimized to the needs of the whole ecosystem required to bring distribution to smaller capitalization companies and support them in the aftermarket. You need a very different economic model, and it has to harken back to what was very successful in the 80s and the 90s.
Well, it sounds like a big objective for you, and a big problem that we've got with the current situation. We're going to take a break for some messages and come back in just a minute with David and ask him for what the solutions are. Stay with us.
And look, happy to be here, Brian.
Well, welcome back to the Brian Crombie Radio Hour, Saga 960. We're chatting with David Weild of Weild & Company, former vice chair of was it NASDAQ or New York Stock Exchange? I forget.
No, it was NASDAQ stock market. Yeah.
And then also worked for IssueWorks for 12 years. What was IssueWorks?
IssueWorks was using technology to broaden distribution on new issue equity. So we were trying to get if the typical sell side Wall Street firm is really only covering 60 institutions, you know, we would sit there and say that and maybe 20 of them are relevant to somebody who's going public. We would say that there's another 250 out of the 3,500 institutional investors in the United States that are not getting actively covered by the big Wall Street firms, and we wanted to use data science to get them to the right 250. And it was actually very effective, but we found that the companies loved what we were doing, but the big Wall Street firms, it was actually taking money out of their pocket. They just wanted to put everything into the same 20 institutional accounts.
Right. So you've identified this problem that we've got and suggested that if we want to get small, innovative, fast-growing companies public, we got to solve the problem. What's your solution?
Well, our solution is we need a new stock exchange that has a different set of rules. We got very close to this solution actually in the United States. It was called a venture exchange, and we essentially would liberate those that were designing stock markets from the requirements of being all electronic, penny increments, or what we call decimalization, and to try and get the economic incentive back into market making. And so. And it was supposed to be set at up to $1 billion in market value. So, and allow companies to choose to be in this market. It would attract research coverage, distribution, and get brokers back in the business of being stockbrokers because there would be enough economic incentive to pick up the phone and talk to an investor about a microcap security. So that legislation was actually bundled in an omnibus package that went through the House of Representatives in 2018, and it passed the House 406-4, and which is remarkable. I mean, you can't even get a proclamation, in support of motherhood and apple pie through the House of Representatives with that kind of a lopsided bipartisan vote. And it was, by all accounts, supposed to get passed into law, but then when by being tacked onto the Senate Appropriations Bill, but that never happened in 2018 because you may recall that President Trump shut down the government over building the wall, and it pushed the whole. It ended the Congress on December 31. A new Congress came in, and what that does is it sets the legislative clock back to zero. So, maybe it'll get picked up under a Biden administration again. I mean, it was very, as you can see, non-controversial. But there's no reason why, for instance, that Canada can't do something similar. You just need to have a market structure that's designed for aftermarket market making and distribution and support, and it would bring down the size at which companies can go public, which is absolutely critical to then incentivizing private company investors to invest more capital, because it makes it more realistic that they're going to get a return on their money through a public market exit.
Now, at one point in time, wasn't NASDAQ the place where smaller, technologically oriented, growth-oriented companies went? And in Canada, frankly, mining companies and things like that were on the venture exchange. That's
correct. And, but what happened was, because of the law changes, and this was in the United States, we had the order handling rules and then something called Reg ATS in 1998, which it stands for Alternative Trading Systems, but that gave birth to electronic markets that caused you to be able to put live investments in place, live orders in place, and it collapsed those telephone quoted trading spreads from a quarter point all the way down to a penny or a nickel, but the minimum they can go to is a penny. And so because nobody's out there making outbound calls, it's very easy for a short seller to get in there, collapse the trading spread, remove any economic incentive, and create an adverse selection. And because nobody is actually getting on the phones because there's no economic model, if all of a sudden somebody puts pressure through short selling on a stock, people see the stock go down, they say, oh my God, there must be something I don't know about, and the buy orders pull out. And it's become very, very easy to manipulate stocks on the downside, which is catastrophic to smaller companies, if you will.
So what have companies done? Have they been able to fight this, or they just stay private longer?
They generally stay right now private longer. We've done a couple of things. I'm on the board of a public company, and we've actually innovated by taking former retail brokers and institutional brokers and putting them that knew the business and hiring them into the IR department and paying them salary plus bonus, and going about the business of trying to create our own investor outreach. And so
they become stockbrokers effectively themselves, or advisors.
Yeah, that's right. We put them back into business, but on a different, a salary plus bonus kind of model. And so we don't pay them securities income, which otherwise would be a violation of U.S. securities laws. But the idea is to build your own shareholder base. And it's been actually for us very effective. I think that there are two companies that I'm intimately aware of. They were both in the medical device arena. And the one that actually did this has now 20 times the number of investors, qualified investors in their CRM database that the one that has been relying on Wall Street has in their database. So that's rather remarkable.
So do it yourself rather than rely on Wall Street brokers to do it.
I don't think if you're public already, I mean, you're going to do one of two things. You're either going to go public much later and or sell the company out, which may cap the upside. It also changes the way the private market, private investors invest. Or if you happen to be public or go public early and it's not working, then our belief is that don't delude yourselves into thinking that there is any economic model for the Wall Street firms that took you public to support you. even over $1 billion, you start to be supported because you're large cap and there's a network effect and you're on enough radar screens so that because all of those different investors that are watching you are starting to make markets, and there's natural information flow, and buy side analysts, investor analysts that are following you, and they'll step in if the stock gets cheap. But when you're dealing with microcap stocks where they're easy to manipulate, the big institutional sophisticated money can't get in and out of the stock, and the brokers aren't telling the story. So it's been an unmitigated disaster. So the Wall Street firms, I mean, literally, if you think about it, it makes sense. If the increments, if you're making 2 cents a share, and how much volume do you really need to do as a Wall Street firm to start making any sense at all to provide research and active sales coverage? And the answer is an awful lot, and that means you have to be an awfully large company. And then when you look at who you're going to cover institutionally, there's a 90% of the commissions institutionally in the United States are found in 60 investors out of the 3,500 13F reporting institutional investors in the country. So that means that, if you're running an institutional equity sales department in the United States, you shouldn't be spending any time at all covering, the
3,410.
3,410 for 10% market share. You should be spending all your time as a manager trying to figure out how you can get a bigger slice of the 60 accounts, the size of the pie for the 60 accounts that generate 90% of all commission. And that's what they do.
In the United States, SPACs were, I think, an attempt at solving some of this problem. And in Canada, CPCs, capital pool companies were. Have those not worked?
Well, they get more companies into the marketplace, but they don't give you the ability to control your own exit. And typical SPAC will look at over 100 investments. And so if I'm a CEO and I want to get public, I can't rely on that. It's like it's a bake-off. And the other part of it is that because they typically have warrants, there's incremental dilution, so it's a dilutive way to go public. And you've got this sort of this trade-off between the SPAC owner wanting to get the acquisition approved, so they need something that is underpriced and compelling, so that the stock will stay above, the SPAC shares will stay above their issue price, and those that hold them will vote to convert into the acquisition. And so I think that what it does is it gives the lucky winner certainty of getting into the public marketplace. What it doesn't do is give you an attractive value that is less dilutive than it would be if we had a traditional underwritten IPO market that worked again for these companies. And then depending on the size, you may find, if the company goes public in $500 million or you have a pack of support problems as a public company. So as I said, it's better than the alternative. It's an innovation that is responsive to the fact that the IPO market is not working the way it used to work. And so the real solution is just to design a stock market that works for what we call asymmetrical order book securities: big seller, no buyer. You need an intermediary, which is a Wall Street firm with a compensation model, an economic model that can go out and hold the stock price there and find buyers to offset the sellers. That's real aftermarket support. And that's what really largely doesn't exist in securities markets any longer. And that's something that was incredibly valuable to the economy and I think to the future of our nation's, your nation's competitiveness that needs to be redesigned back into markets.
So it's going back 30 years in the stock market for companies with a market cap under $1 billion, I guess.
Yeah, exactly. I mean, I don't, there was nothing that worked better, right? And so I'm sure there'll be some twists and some technological automation because the world has changed. But the basic concepts that made that market so successful, that birthed entire new industries, that got companies public when they were doing a $25 million IPO and they could be supported. I mean, Intel went public in 1971. It was an $8 million IPO. Okay.
Couldn't get done today.
No, couldn't get done. I mean, Microsoft was about a $50 million IPO. Couldn't get done today. I mean, you look at these things and it's just really shameful, what we've kind of done to ourselves by undermining the best, IPO, job formation, innovation, national security engine that ever existed in the history of mankind, and the ecosystem that was required. Remember, it's not just the market. It's going to take years to build it back, because once the economic incentives are there, broker dealers are going to have to build out infrastructure, including research to cover the stocks and put salespeople in place. And institutional investors will have to create smaller funds, and that entire ecosystem that
got to be recreated.
Yeah, that's exactly right.
What a fascinating conversation we're having today with David Weild of Weild & Company, talking about stock markets and how they're not serving the interest of getting smaller companies, those companies that are creating the vast majority of jobs in technology, public today. We're going to take a break and come back with more in just a minute. Stay with us.